All right, welcome everyone to episode number 7 of the Wide Lens podcast. I'm joined here, as always, with my colleague Matt Rigby.
How are we doing? Welcome back, everyone.
We are recording this on Thursday, the 10th of March. We are timestamping this right here, right now. And we're going to be covering the latest in finance and investment markets. Don't forget to jump on YouTube, check it out. We're getting some good hits on the YouTube channel, and people are still downloading on the podcast, which is awesome. So please keep it up, guys. And we're getting some emails actually, from people.
You sound surprised. No donut tips, but we'll get there. That's all good.
So let's kick off with Matt's Market Minute.
All right. So all this data is from Refinitiv. Just to let everyone know. All right, so the Aussie market over the last 5 days is pretty much flat, up less than 0.5%. And for the year to date, down about 6%. So something like yesterday was about the best day in the last 3 weeks. And today's up over 1% as well. Notable movers, Newcrest up 6%, Mesoblast up 7%, had a good day a couple of days ago. And Nickel Mines, which is interesting, down 26%. We'll talk about nickel later, but their largest shareholder was short a fair chunk of nickel.
Who was that? Was it that Chinese company?
Yeah.
Chinese?
Tingshen. I don't know. I'm just going to embarrass myself. Tingshen?
Right.
Is that it? I don't know. Anyway, down short a good chunk. Fears that they may go into default. They are in a chunk of nickel mines, about to receive a whole lot more shares as well. So that could be hanging over the market as a bit of a downward pressure. The Nasdaq down about 3.5% over the last 5 days, still down 16% year to date. The 5 largest stocks, I just thought this was interesting. Tesla's down 4.5%, Google 5%, Amazon 10%.
In the last week?
In the last week. Amazon 10%.
10%, yeah, wow.
Microsoft 6.5%, Apple 3.5%. So Apple doing quite well, released some new phone versions yesterday or today.
Yeah, saw that.
So interesting. Year to date, 18.7% down. 69 stocks in the Nasdaq 100 down more than 10%.
How many?
69. So 69% of the Nasdaq is down.
Is the
more
Nasdaq
than
100 or
10%.
composite?
100.
Wow.
13 in positive territory. Pretty average. S&P for the week down 2.5 for the year to date down 10.5 or 10.8. Disney down 9.5, sorry. Chevron up about 14. Match Group up down 20%. So for those who don't know, Match Group, Tinder, Hinge, OkCupid.
I'm all over
in the business of hooking people up. Year to date, 24% positive, 44% down, more than 10%. Schlumberger up 50, ExxonMobil up 43, and Baker Hughes up 44%. All oil or oil services companies. So interesting. Emerging markets finally starting to feel the brunt, down 10% for the year, about 3%. Week to date. Oil up 2.1, moving past $130 a barrel, up 46% this year.
Where's this going to stop, you reckon?
Oh man, it's a great.
Can you see $200, you reckon?
I don't know. Russia can see 300 apparently. I mean, they're motivated to say that, but
to the moon.
I don't know. Maybe. Where's my Tesla? Hook me up with battery cars. Gold's up 8% year to date. It's moved lately. Yeah. Bitcoin up 10% since Monday.
Where are we at?
Still down 12% for the year at 41, almost 42 grand.
Yeah.
So interesting, very interesting. All right, so getting into it. So there's been a bit of commentary lately that commodity spikes lead to recessions. This is the I guess the lead story coming out from a lot of brokerage houses and research companies. Bespoke came out with some information, as they often do. Look behind the rumors, look behind the headlines, and what do the actual stats show?
Why is that though? Before we dive into things, why do commodity prices? Why do commodities? Why is that the rhetoric? Why is that the headline?
Well, think about consumer spending. You know, people are driving. Everyone's driving a car. So as oil prices rise, it hits the pocket pretty quick.
And it's not like they don't stop driving because of that.
No, but oil's a big feeder into so many things. So that's direct inflation, but all the indirect inflation. You mentioned a few weeks ago about delivery. So as it's more expensive to deliver stuff, that gets passed on. It gets fed into all sorts of goods. And you just see this wholesale rise in inflation.
Do you think like commodities, whether it's soft or hard commodities, is almost like a mortgage repayment whereby people talk about it's bad when it goes up, but consumers continue to pay. So when people talk about a home loan rate, interest rates going up, and what they do is that unless they want the bank coming and repossessing the house, they will go and spend this money on that thing first. And then it has implications sort of down the ladder. Is that kind of how we think about it?
They're probably second in line. I mean, the mortgage and then eating, right?
I'm talking more conceptually.
Yeah, no, I think you're right. I think, you're not going to go to the movies before you stop having your dinner, as an example. You're not going to eat
out,
to the
movies.
You're going to eat.
You've run out of money because petrol.
You can't afford. You just sit there and listen to it from the outside. So maybe you don't go out to dinner, you eat at home. So that's a step down. That's services, obviously. But, it feeds into everything. So I think that, and you think about, white goods, all the steel that goes into those and whatever else. So, it's pretty wide ranging. So, this first chart here that we'll bring up is commodity price surges often precede recessions. This is the line that
That's the headline,
fed.
Right?
That's the headline. So you can see some pretty significant rises here in 1972, 1980, 2008, and now this one from 20 and ongoing. So as you can see in the chart also that there are those grey areas that are the recession. So there are some times when the rise does precede a recession, but often, there are so many recessions that aren't following commodity rises.
It's not always the case.
It's pretty inconsistent, as most of these things are. If there was a hard and fast rule, then, we'd all be over it. And so with so many of these things, they don't actually pan out. So they had a look at some of the data, and as we show this next chart or table, so they're looking at when there is a recession, what was the rally or what was the change in commodity prices at various intervals prior to that recession?
Before the recession.
So the 3 months prior to the recession in 1969, commodity prices had risen 20 odd %, 20 and a quarter. 6 months prior, they were actually down, 12 months flat,
Gotcha.
blah, blah, blah. As you can see here, it's pretty inconsistent. You've got in 1979, commodity prices are up 101%. But in 1973, 81, 99, and 2001 to 2020, commodity prices are actually down in the months prior to recession. So I think you can see it's pretty inconsistent. And if you go out to 12 and 18 months, which is a bit more of a consistent timeline or a bit longer for that trend to be entrenched, the odds of a recession is, we'll call it 30%, 27 and 37%. So a 1 in 3 chance that if you've got a big rise in commodity prices 12 or 18 months prior to a recession, for a 12 or 18 month period, then you may end up having a recession.
So the fear is that, so if we have high commodity prices, which then start pushing inflation, and we are in a situation now where you and I, and everyone's been talking about inflation, and we've been talking about our view that we think it might be transitory, depending on how long transitory means. But now we've got this second issue that overlays this, which is geopolitical instability and real concerns and issues around the world, which is causing what we're seeing now from hard commodities to soft commodities. And that's just, I feel like it's making the situation worse than what it may be. And I feel like it doesn't even give the previous situation a chance to even just kind of see whether the supply chain really was the issue causing inflation.
Absolutely. And it's as much about where this geopolitical issue is as much as anything. So if you've got geopolitical issues in the Middle East, it affects oil, but it's kind of limited to that. Russia and Ukraine, as we'll look later, hard and soft commodities, they're big producers on a global scale.
Surprisingly, some of those numbers are pretty high. But the other thing I just wanted to touch on was, if you look at the likes of 2007, where we talk about central bank induced recessions, where you've got rate rises, I think part of the fear is that and we'll talk about it later about the RBA coming out and kind of having a change of their tune, is that central banks come in and they may fall into the trap of inducing ourselves into a recession.
Yeah, and look, central banks, they've got two targets, that is price stability and employment stability. So price stability, all of these, as I was saying earlier, all of these commodities rising feeds into a really broad basket of goods and services. The Fed or the Reserve Bank see that happening. They start raising rates, prices are going up, so you're getting hit in the pocket from food prices going up, you're getting hit in the pocket for your mortgage going up, and at some point it breaks. And
I feel like the central bank gets cornered, especially the Reserve Bank, because there have been so many people coming out and saying they're behind the eight ball.
Yeah.
And the central banks are just getting crucified. That was before even there was a Russia-Ukraine thing, and now this happens. I feel like it's like final blows.
It's exacerbating the inflation issue, like enormously. It's not helping. It's terrible. I mean, it's kind of frightening when you think about what's happening around the world. And if it's bread and cereals and that sort of stuff that's going up, and of course, that
it's stuff that causes real problems.
It is, and they're the essentials. That feeds into livestock feed, and it just kind of ripples all throughout.
It's like, who gives a shit that you can't? But you have to wait 9 months for your Porsche because of supply chain issues. Now we're actually talking about my sourdough loaf's gone from like $6 to $12.
Yeah, I mean that's real.
That's real.
Every week price inflation. So you're right. I think the Fed Reserve, there were concerns that they were behind the ball. The RBA concerns they were behind the ball before this started. Can they ride it out? Are they willing to sort of ride this out and hope the conflict ends? Hope these supply chain issues end? And this is all going to cause supply chain issues in and of itself.
100%.
Because I think Turkey blocked Russian ships getting out of the Black Sea. I mean, you've got all this stuff going on. So dare I say it, I mean, we could be in for a massive spike of inflation
for a lot longer than...
Can the Reserve Banks hold their nerve? And I think they probably won't be able to.
Do you think that the market will then be the lever that prices need? So, i.e., things get so high that I'm not going to pay for that thing anymore. Or are we talking about goods and services that are sort of more everyday?
I think both. I think you're talking about goods and services that are everyday, but that will result in the luxuries, the chips or the soft drink or whatever it is that aren't essentials, they'll start dropping off. And when that starts to happen, then that's when the economy really starts to get in trouble.
I'm less optimistic about all this than I was a month ago. I feel like the whole lay of the land has changed.
I agree.
I feel like I just need a bit more time to see what's going on to kind of have a point of view here.
And it's moving so quick. I mean, commodity prices are just spiking through the roof. So I think the impact's going to be greater than we all hoped or expected.
Dust those cobwebs off the bike, Matt. You're
start pedaling.
Stop driving. Let's move on to the next topic. Investors not yet panicking, and so we talk about panic and whether central banks are going to be panicking. Right now, I think we're talking about inflation. We're talking about valuations. We're talking about interest rates, and we're talking about a whole bunch of things before even Ukraine and Russia was a thing.
Yep.
And now that that's a thing, it's even more reason for people to be, and investors to be panicking. And literally, we talk about unclipping the seatbelt and jumping out of the carriage. That's where the situation we're in now is the most compelling reason to do so.
Yeah.
So might just bring this chart up, which is really interesting from Sentiment Trader, which they've titled it, "Despite numerous concerns, the panic button has not yet been pressed." And when they talk about the panic button, they talk about this particular index, if you like, that looks at a whole bunch of things. So it looks at interest rates, it looks at credit, it looks at valuations, it looks at stock market volatility, a whole bunch of things. I'm not going to go through every single thing in here. But what I found was really interesting was, it goes all the way back to 1955. The things that are probably more recent in my mind is you look at Russian default, ironically, back in the late 90s. We've got GFC, we've got Brexit back in 2016, and then we've got the COVID pandemic in 2020. Look at where those spikes are versus where we are right now. And so even though all of this is going on, markets, and if we look at broad markets, seem to be relatively tame to potentially what they have been in the past when we've seen these types of events unfold.
Yep.
And so even though things look pretty pessimistic, things I think potentially could get a lot worse. And that may be the case before things get better again. But certainly, and we'll talk a little bit about this in a couple of the other topics we want to cover off, history is showing that looking ahead, 6, 12, 18, 24 months' time, things look pretty positive. But, that's only a guide. There's no guarantee. So I thought this was interesting. Things always look like things are really bad when you're in the midst of it all.
Yep.
But looking and putting all that together, certainly according to this particular index, things look pretty good. So,
why do you think it is that people aren't panicking? I mean, you listed a whole bunch of things there, and I honestly expected Russia, Ukraine, while it's not, I mean, it is having global ramifications, but it's easy to kind of push that off to the side. There's so much else going on, and we saw earlier in the year that the inflation and Fed. So why isn't that this war has added to that and finally broken the spirits of investors?
People are being more educated and listen to our podcast, Matt. That may not have a severe implication.
We're having a global influence.
But I think one of the biggest things is if you look at the GFC, the pandemic, I'll have to think about that one, but certainly GFC, like people just, I mean, if you think about banks and the money flow and the money system, that came to an absolute grinding halt. That's not an issue as we speak right now. So I think if you think about sort of the underground plumbing of the financial system, that seems to be flowing quite well. And one of the inputs into this particular index is credit markets, credit spreads blowing out.
Yep.
And we're not really seeing that at the moment. So I think that if that started to blow out, then there'd be, I think, greater concern. But that seems to be functioning okay.
Yeah, no, you're right. It does. And I mean, it's always hard because the news headlines are not screaming markets are crashing. And that's always a pretty strong indicator that I think causes a lot of people to panic. You think about the pandemic and Lehman Brothers. I mean, it was splashed everywhere, crashing, this is going, banks are failing, people losing their jobs, all the rest of it. We haven't really seen that yet. And maybe jobs is a bit of the key.
The headline is Russia, Ukraine.
Yeah,
that's the only headline right now.
And I think when people can see it in their own backyard, it's a bit more of an issue.
I mean, we talked about this last week. I think it was investor or consumer contradiction, which talked about people saying one thing and then doing another thing. So we've got record retail sales. We've got wage growth. So there's
record low unemployment.
And whether that's because people can't find staff from offshore, I don't know whether that's a thing or not. And I don't want to go into that now because we can talk about that forever. I don't know where we're going with this, but I do feel it is slightly different. I think credit markets is a really, really, really important piece of the jigsaw puzzle here.
Yeah. Yep. All right. What else you got? Bit of volatility?
Let's jump on to, talking about volatility. Bespoke had this piece, which I thought was fascinating. I'll just bring this chart up now, which is the volatility index over the course of the last 12 months. And you can see the spike above 30 back in the back end of last year when we had speculation of rate rises.
Yep.
And again, we're starting to find ourselves beyond the 30 number over the course of the last few weeks, especially since Russia and Ukraine. And so when we look back at the history of the VIX, there has been just 16 prior periods where the VIX closed above 30 for at least 7 straight days.
Right.
And so...
that doesn't feel like many.
No, it's not. And so that leads me into this next chart. So if we go back to 1990, so what's that? 33 years. So in the 33 years, 16 times. It's not many at all.
No.
And so what Bespoke did, which, we love looking at real facts and figures and just having a look what the data says, not less so the headlines. And so what this is showing is every time the VIX closed above 30 for 7 straight days from 1990 to 2022, even though some periods last a lot longer than others, look at 2008, 2009 during the GFC, that lasted 170 trading days compared to 1990, 1991, and even during 2020. I mean, we talked about that recently, that we had such a short decline in the stock market. But when we see what does the stock market then do a week, a month, 3, 6, 12 months later, a week later is not very helpful. Maybe a month later is not even that helpful. But when you start looking 3, 6, 12 months following when we have a seven-day consecutive VIX index above 30, you start to see what returns you get. So have a look at the bottom of that chart. You've got average returns from 3 months in going 8%, 6 months, 13%, 21% 1 year later. Have a look at the median returns, 25% 1 year later.
17.
And then you have a look at the probability of positive returns following those periods. I would take 70 to 74% odds in my favor.
Yeah,
of having
absolutely.
a positive return.
Yep.
And so if you've got a positive return and the average and median return during those times are 13, 17, 21, 25%, I feel like they're pretty good odds. But obviously we're taking a risk, right? Like we said before, we don't know how all this is going to unfold, whether central banks are going to panic and start raising rates a lot quicker than we had anticipated from 2 weeks ago. That's the risk.
Well,
what do you think about that?
It's interesting there that in all periods it's 70, 74%, but after 7 straight days above 30, it's 81 and 88. So, history would say as the volatility increases, people start to sell out. That's your time to get in.
Yeah, but that's not intuitive. It's
not.
It's counterintuitive.
And it's difficult to do.
It's really difficult to do.
You see the market falling. And again, remember, 2020, those headlines were constant. I mean, the news, radio, everywhere, markets falling 1,000 points, biggest one-day fall ever.
Yeah, but we haven't. We haven't
seen any of that this time around. No, but the volatility has been up. Which is
it has. But we've seen it in the stock market to the extent that individual stocks have been killed,
as we saw earlier.
Yeah. But the broad markets haven't felt that type of pain.
But it's hard to buy back in. So you talk to people now about buying tech or buying just the market. Everyone was wanting to buy tech 6, 12 months ago. Now, less so. And it's because of that buying when everything's falling, when it's all hitting the fan. But yeah, really interesting. I did enjoy this because it certainly goes against the narrative of, volatility, get out. We keep saying.
I read on LinkedIn, there's all this stuff going on about Ukraine and Russia and or whatnot. And then people are making comments about portfolios. And one particular person made a comment that this is now the time to have good quality portfolios, which I don't disagree with, and holding lots and lots of cash. I'm like, what? Is this the time to be holding cash? What are we waiting for? Yeah, why would you hold cash right now?
What's your trigger to get in? I mean,
wait for the stars to align.
I don't know.
Give me a break.
Holding good quality companies. I mean, that top 5 I said earlier, outside Amazon, none were. They were all down.
But why would anyone hold cash right now, Matt?
I don't know, because you've got an immediate expense that and you can't risk it.
You're not being. You've got no return on cash. That's the first thing. Second thing is you've got markets 10, 15, 20, 25% cheaper than when they were 3-6 months ago.
Yep.
Why are you holding cash?
Yeah.
You were prepared to buy assets
6 months ago.
9 months ago. At
when the market was
ridiculous
higher.
valuations with now the benefit of hindsight.
Yeah. Yeah. No, absolutely. And I think that person's right. You buy good quality companies, diversify your portfolio. Yeah, a little bit of cash, but I mean, I wouldn't be holding any more than
big amounts of cash.
3%.
Let's move on.
Yeah, so
we're just talking about stuff that's going up, except stocks.
Eventually, we'll get to talk about stocks going up. They rallied hard last night in the US. So this chart, couple of charts here, the same sort of theme, just talking about inflation and the volatility of everything is kind of what it feels at the moment. So this chart here, I think we can split these two into the weekly change in wheat futures. So if you're not aware, Russia and the Ukraine account for around 30% of global wheat exports.
I didn't know it was that high.
No, it's significantly higher. So for perspective, Australia's about 9.5%
Of the global
wheat exports.
That's
That's after our consumption, although we probably import it. But so we export our wheat, so we're 9.5%. The US is slightly bigger than us. Russia is the largest. So, so obviously with the conflict, that puts a lot of strain on production, especially in the Ukraine. Russia, I would imagine they're still producing, but there's now this potential that they may weaponize some of these soft commodities.
What does that mean?
Well, they might start holding it back. So you put sanctions on us. Well, we're going to make you feel the pain.
What are they going to do with all that wheat?
I don't know.
Lots of loaves of bread.
Yeah. No idea. Who knows? Feed the troops.
But interestingly, sorry, I'll let you finish.
Yeah, I was just going to say, so we saw an enormous spike. And this
huge.
first chart here goes all the way back to 1960. What's that, 60 years? It's absurd. It's a near 60% spike in wheat future prices. However, as we always like to do, put things in perspective, widen the lens. And this second chart here, which goes all the way back to 1842, which is a very long time. What's that, 160? I don't even know, 180 years? It's a relatively mild bump, I would call it.
But I think
this stage, there might be more to come.
The real price. What you're showing is the real price of wheat per bushel, USD per bushel.
Yes. Yeah.
And so when you take even when you take inflation into account,
it's going to be less.
It's actually it's a big spike, like relatively speaking, for the last 10 or 15 years or 20 years. So we haven't seen really anything like that for the last 20 years.
But we haven't seen anything like this in anything for the last 20 years that I can think of. I mean, I look at all these charts and we go through quite a few, and there's just this constant trend of the last 20 years have actually been really quite good. In terms of, oil prices haven't really spiked as they did in the 70s. You haven't had soft commodity prices spiking. We've had this fairly good period, and granted a couple of recessions, but overall, interest rates have come down,
What do you mean? We had a pandemic.
Yeah, but we all came through it pretty well. We didn't see anything like these. So pandemic, yeah, all right, we're a lockdown, and it was shit. I mean, it was absolute hell. But in terms of...
Is that enough? Like, what else do you want to see in 20 years?
Mate, I want to see another 20 years like we've just had. Up until 2019.
In terms of what?
Well, just in terms of stability. I mean, look at global conflicts. I mean, there was...
What do you mean stability?
Yeah, I reckon.
What type of stability?
Price stability. We've had fairly good price stability. We've had great unemployment stability. Granted GFC, there was a big spike, but it recovered pretty quickly. And if you look back over the last 20 years relative to the last 150 years, I think we've had a relatively
but don't you think
benign period of...
Yeah, I agree with that. But I don't think you can compare what happened in 1844
Well, we are.
Well, in the chart we are.
Sure.
But that's why
different time.
But that's why people break up periods when they say pre-World War II, post-World War II,
Yep.
and maybe even
industrialization.
Maybe there's even a pre-GFC, post-GFC. I know. When we've done some work and when we put our deck together, there's some, there's some charts that we look at as it relates to interest rates and the impact that has on stock markets, and it's pre-GFC, post-GFC.
Because it has been a very different era.
I just think it's totally different.
Are we about to pay for it? Is this inflation, which people have been talking about for ages, inflation's going to come? That's what the central banks wanted. They were trying to generate inflation. Are they finally getting what they wanted? And will they start to regret it? I don't know.
Time will tell.
Time will tell. Anyway, so wheat prices spiked.
Can we talk about the Aussie market? I feel like, one of the things you said it's been relatively benign. The other benign thing has been the Australian stock market has been pretty benign since the GFC. Am I wrong?
It took forever to capture the
Nothing's
GFC highs.
happened. Nothing has happened. But what we're seeing now, and everyone is seeing, is the Australian stock market performing actually quite well when you compare to global peers, and especially the US. Bloomberg had this particular article: Australia outshines developed global peers on profit outlook. Earnings estimate in Australia have surged 10% this year. Upgrades followed better than expected February result season. And we'll get this chart up here, which shows up profit changes relative to peers. So the red line is Australia, and just by way of example, you've got the bottom line there, which is the S&P 500. And the black or the grey line there is the European top 600 stocks. And so I look at that and think, wow, like Australia, since back end of January really is when profit estimates started picking up. Why do you think that is? Is that just like a commodity story? What is it? What is it?
I mean, look at the makeup of the market. Yeah, we've got BHP, Rio, Fortescue, the big four banks, Macquarie, big five banks. Who else is there? CSL, a couple of others, I'm sure. I think
Nearly
commodities
10%.
are, interest rates are turning around, so that's great
Good
for the
for
banks.
banks,
So there's
yeah.
5 of your top 10. Add in, a couple of commodity companies and supermarkets. Are they up there? I can't even think who else is in the top 10. But yeah, I think that's probably a big factor. Whereas you look at the US, it's all tech heavy, and everyone's downgrading tech earnings. Although the five largest
do you think
are
it's a
making
game
great
of
money.
relativity more so than absolute, or do you think this is an absolute story?
Yeah, that's a good question. I don't know.
So I'll just bring this second chart up. I thought what I'll quickly just do is just put the S&P 500 index, just price, over the all ordinaries. And this is year to date. So January 1 to today, 10th of March. And you can see the S&P 500 down almost 11%. The all ordinaries down almost 6.5%, let's call it. But it's not. But if you have a look at that chart, it's not really until sort of mid-February, early to mid-February, that the Aussie market starts to outperform.
Yeah, which surprised me. I was a bit surprised how closely they were following each other up until that point. And again, I think when did Russia invade Ukraine? It's
Like
2 weeks ago,
23rd, 24th of February.
Is the end of Feb. Yeah. So, commodities again probably played a part in that. I would have thought the interest rate expectations here in Australia or increasing rates here in Australia, the expectations were a lot lower than the US, and we probably would have outperformed prior to that, which hasn't been the case. I don't know, but going back to your absolute or relative performance, I wonder whether it's a relative, in absolute terms. Some of those high tech companies I think will grow their earnings faster than the largest companies in Australia, but the rest of the market maybe isn't growing as quickly.
Do you think people are going to be pretty excited about this, like Aussie investors? Obviously, Aussie investors have had a pretty shitty time since the GFC. And if you really haven't owned international, specifically US stocks, your portfolio has been lagging really, really hard. Whereas now we're starting to see a glimpse of this turning point where the Australian market is turning. We've always been global investors here, and that's been it's worked out quite well. The Australian stock market makes up 22% of the global stock market index, and I guess there is a reason for that. And the question that I'm curious about and want to ask you is, like, how much Aussie exposure should investors have in their portfolios?
Oh man, I don't know.
Because these things are secular, right? Like commodity booms.
They're unpredictable, and they
but
don't
when
last long.
When they run pretty damn
They run hard, absolutely. But they.
But how
stop
how
pretty
tempted
quickly
do
too.
investors get with that, and how excited does the Australian investing community get when you've got the likes of BHP and the banks roaring, like we're relatively speaking?
Yeah, I think it's really interesting. So I was in the US for a number of years, came back and was pretty surprised at how low the international exposure was in most mum and dad's portfolios. And I think a lot of it comes down to dividends and franking credits. I mean, that's a big factor as to why we invest a larger portion in the of our portfolio in Aussie shares. To get to your question, what percent? I think honestly 15, 20%
You reckon?
max. That would be my thought. It's hard, those franking credits when you're in pension phase and zero tax. I mean, it's pretty appealing. That's a free kick. So a company goes ex.
Yeah, but who gives a shit when your investment lags so much?
Well,
I'd rather take a return on my investment than look at franking credits. Like I would do a comparison return in that sense. Like,
sure.
Does that make sense? What I'm trying to say?
Absolutely, but I don't think everyone thinks about it like that. So people go, I've got my CBA dividend and it gave me whatever in dividends. Look at all this franking
Where
credits.
do you think that money's coming from? It's a dividend payout ratio, right? Like,
and it's a lack of reinvestment,
100%,
which is why earnings aren't growing as fast, which is historically why Australian shares haven't done as well.
Interestingly, this time around, it seems to be. Or was that profit? That was profit. Profit pickup.
Profit, yeah. So look, I don't know. What do you think it is? What do you think the average Aussie portfolio?
What is it now?
Should have. No, what do you think they should have in their portfolio exposed to Australian shares?
If you use global market capitalization and it's any guide, it should be 2%, 3%. But I agree with you. There is an aspect of bias and yes, franking and all that stuff. It depends what type of investor you are.
Absolutely.
If you're a retiree, sure, that actually makes a big difference to your bottom line.
What was sort of saying. I mean, it's a free kick. Your share price will drop by the dividend, not by the dividend and the franking credit. So you pick it up twice.
But if you're in accumulation phase and you're a young investor, I don't know, 10% of your portfolio.
Yeah,
I feel like
zero. I mean,
I don't agree with zero. Like then you forego stuff like this when they pop.
But maybe you've got that exposure to value stocks elsewhere, and so it'd be interesting to look at value versus the Aussie market, given the
global value or Aussie value.
Global value versus the Australian share market, given the composition of the Aussie market. That would be interesting. Maybe it's more correlated than we think. I don't know. Yeah, let's put up that on the agenda for a future time.
Global value versus Aussie.
That's it. All right, moving on. So the Nasdaq and
we're in bear market.
Look out! Hear the bear. The bear is roaring yet again. All right, so this is basically just looking at where major changes in the Nasdaq market, 20% or more, of which we've just peaked over that in the last few days.
It's like down 21, 22%, isn't it?
It was. It rallied. The Nasdaq was up 3.5% last night. Massive. Anyway, so when we've had moves of greater than 20% down in the Nasdaq, what does that mean? Again, what does that mean weeks, months, and a year on from that point in time? So you can see this chart here. We'll bring it up now. It goes all the way back to 1971. So this is from the 52-week high, a 20+% fall. The number of days that it took to get there, number of days before the bear market finished. So I'm going to pick on 2007-8 again. So it was 98 days to get to that 20% mark, and then there was still another 288 days before the bear market ended. So 386 days in total. So what happened after that? Well, 1 week, doesn't matter, 1 month, again, too short. 3 months, 9%. And in this case, it was actually a negative 30%. Now, we've talked about this a few times. Why was that?
What happened?
Just because of the period. So they're taking this point from where we hit that 20%. So there was still another 288 days of bear market.
Oh, gotcha. Yeah? So it's like another year of bear market.
Another year, yeah.
And so what are those really low periods on the far right, the 1 year? It's 1974, 2000, so through the 2000, tech wreck. Yep.
Yeah,
and
so we've got
then the GFC.
3. So how many have we got here? 6, so we've got 10 or 11. So 3 out of 11 where we've hit this point. But as we like to do, looking at the average, so average of all periods, average of periods where we've had a 20% decline. And when you go out 12 months, the average return is 21, the median 16, 75% of the time we've had
There's similar odds to what we were talking about before.
We keep coming back to this.
The 70,
1 in 3,
the magical
3 and 4, 1 in 3 for a recession, or 3 and 4 positive years. There's a pretty consistent theme here. So again, and that lines up pretty well with all periods, positive 76%. So there's not a drastically different as I thought it might have
Do you
shown.
think? Do you think this is pretty worrisome for short-term investors? Like, think that the seas are pretty rough right now. If you're a short-term investor,
Yeah.
how different do you think it is if you're a long-term investor?
Yeah, it's funny. I was thinking about this.
Is it an issue
yesterday?
Should they worry?
I don't think they should. I think you should just keep investing like you are. Keep your SG payments, your super contributions.
What if
investing,
they're pensioners? What if they're relying on their portfolio to generate income, and that's their nest egg? Like, do they have a different point of view on this?
Well,
or should they never have been in this situation?
Should be holding more cash. I mean, you should be.
What now? Do they cash out now? Or
No. They should have gone into it. But I think this is not to say they
shouldn't have gone into it.
No, they should have had more cash.
Going into it.
I mean, you've got to manage that. But I think they'll be okay as long as those dividends keep coming in.
What if they stop?
Well,
shit
as
hits
they
the fan?
did in 2020. Everyone was cutting their dividends.
Yeah.
It was pretty nasty. At that point, I mean, I think you've got to make the decisions. Maybe you attack your defensive part of the portfolio. I don't know.
Well, that's getting hammered.
Not personal advice, but maybe it's getting hammered less than
so
stocks.
It's relatively speaking.
It's all relative. But yeah, I mean, it goes to diversification, goes to managing your portfolio appropriately, not going all in if you know you're going to need money at some point down the road in the next 1 to 2 years. Another thing I just wanted to note, and I saw this morning, so Bespoke came out and noted that it was today, March 10th, is the 13-year anniversary.
It is too.
Since the market bottomed in 2009.
Is there a party or something?
We'll bring beers next time. So anyway, so they just ran the numbers of kind of what that meant. So since then, since the bottom, the equity market has roared, rallying 531%. That's excluding dividends to yesterday's close, which was an annualized return of 15%.
So say that again.
531% since the low, and a 15% annualized return over those 13 years.
Yep.
And so this chart here, or this table here, which we'll bring up, breaks down each sector. Now this is the US, but pretty fascinating. I mean, technology, look at that up there, 21%. I don't think anyone would be surprised
since
by that.
the bottom of 2009.
Since the bottom.
So what's that first column saying? Percentage change during the GFC.
So down 53%, and then it's since from that bottom point, it's up 1,160%.
So is it? So it's not the thing that fell the greatest didn't rise the greatest. So financials there are sitting there with the biggest decline during GFC. It necessarily wasn't. But man, it's sitting up there as the third best performing thing up there. That's pretty good.
With a background of, or a backdrop of, falling interest rates. So that has been quite a good, quite
fair
a good
point.
return. The other thing I found really interesting is energy. So energy is absolutely on a tear this year, absolutely flying. And, 5% annualized return over the last 13 years. It's just some interesting ones in there. Anyway, this next table, very quickly, the top 10 best performers. Since 13 best performers since the bottom in 2009. Dexcom, Nvidia, Apple's in there at some point, sort of towards the bottom of that list. Domino's Pizza,
man. I always
killing it, man.
They
absolutely killing it.
Yeah.
I heard the other day they've had 13 years of consecutive earnings per share growth every quarter. So 13 times 4, number of quarters of consecutive earnings per share growth. I mean, they've just absolutely killed it. Netflix is in there, one of your favorites. AMD, so on and so forth.
So just interesting on that one, like Domino's Pizza, the percentage change during the GFC. Do you reckon anyone bought that after it fell 67%? Who bought that?
Don't know. Not me.
Look at the annualized return since then.
Yeah, 30.
It's like 40%. Crazy.
Nvidia, 42%.
Yeah, Nvidia was just, I don't know what they're down since their peak, but they were just going absolutely gangbusters on the chips.
Yeah, yep. And then the other end of the spectrum, the worst performers. Now, this is kind of the reason I highlighted energy early, just before and earlier. So Baker Hughes, Schlumberger, ExxonMobil, some of the best performers in the market this year.
Right now.
But during the GFC, absolutely hit. Since the GFC, their return, absolute return and annualized return is pretty average at best.
Their annualized return?
Yeah. So
What do you mean? ExxonMobil? Okay, the
2.4%.
worst. I'm sorry. Yeah. Gotcha.
So I think this goes to the
ExxonMobil
point
is like
that
the best of the worst.
pretty much, and it's not great. I mean,
Yeah.
well, I don't know what cash is since that point, but probably not much worse.
Is Carnival CCL the cruise ship
Yeah,
company?
that's the cruise ship line. They were probably doing okay until 2 years ago.
So no one's going on cruise ship because no one's got any friggin' money. And they get hit with this global pandemic.
And you're still not going on.
And then that's gone, and now they can't fuel the damn thing.
It's so expensive. You've got to push your prices up.
Man,
no one
that's
can afford
a
it.
tough business to be in, isn't it?
It is. And I think this speaks to commodity prices. Yeah, the pretty average return is over long periods of time, but over short periods, they can have exceptionally strong returns, which is what we're seeing this year. So, I just thought that was pretty interesting.
Let's jump into directors' cuts. So we talked a couple of weeks ago about Volkswagen spinning off Porsche in the pursuit of trying to capture an EV market. Let's bring up this chart from Statista that was, and you mentioned Ford was spinning off their EV business. And look, super quick on this one. What I found really interesting on this, which talked about Ford when they were talking about reconstructing their business to catch up with EV. This chart here from Statista lists the battery EV or any EV business that's either battery or plug-in hybrid. And look at Tesla sitting up there. They've got no plug-in hybrid, 100% battery EV. Volkswagen sitting up there. And it looks like they've got a bit of a 50-50 share between battery EV and plug-in hybrids. I don't know who's BYD.
It's a Chinese. Berkshire Hathaway own a chunk of them. Chinese producer.
GM, and then you've got Stellantis.
Yeah.
Is that?
Chrysler.
Yep.
PSA. Yep.
And then there's a whole bunch of other players in between there. And look where Ford's sitting.
Man.
And what was the whole concept of Tesla's going to sell batteries to other companies and other car manufacturing companies?
Yeah.
What happened with that? I feel like that kind of died.
I think maybe they're producing so many cars now, they don't have enough spare batteries to sell.
Well, that's a
Possibly.
slight problem.
Yeah.
But it just kind of highlights how far behind Ford are, especially when you talk about the market leader being Tesla.
I'm surprised by that GM number, that they produce that many battery
I was surprised too.
Versus plug-in hybrid, as opposed to internal combustion.
I saw a Maserati in the car park that I park at. They had this.
Is that the one you hit? He didn't really.
I don't know what it was. Was he charging something else, or was this an old one? But he had it plugged into the wall with like a computer cable. I don't know what the hell. I didn't want to go close enough. It may or may not be. I don't
Charging
know
his computer.
Anyway, let's move on. We're already short on time.
Disney, interestingly, are launching an ad-supported version of Disney Plus.
How much is it anyway? How much cheaper can
it's
it
like
get?
$108 a year. I think they've just put the prices up.
Was it $9 a month or something?
I think something like that. But I was really interested in this because Netflix are seeing a slower user growth. So I wonder whether, so those who don't know, in the States, Disney have Hulu Plus or Hulu, ESPN and Disney Plus, and they bundle them as a group, or you can get them
so you're not
individually.
talking about Australia, you're talking about the US here now?
No, this is in the US and globally. In the US, it's going to launch later this year. But I wonder whether in the US, they're seeing the ad-supported version of Hulu, more subscribers, it's a more profitable model to do that and push them into the...
Is that what Hulu has?
Yeah, they've got both.
Right.
So I'm just really interested to see how this plays out. It'll be interesting to watch the subscriber numbers over the next few years. So I wonder if they know something Netflix doesn't. Interesting.
Well, I hate ads, so I would 100% pay for the...
Far out. They're so over it.
Let's talk about
nickel price.
Nickel price. So we touched briefly on it with what's going on with the Chinese company shorting the price of nickel. And so we saw on Monday, we saw a 66% rise and a 250% rise over 2 days. And that was on a short squeeze and margin call.
The volatility of everything, right?
It's the volatility of everything. And when, let's just bring this chart up from Jim Reed from Deutsche Bank, and it shows a daily percentage change in nickel on the London Metal Exchange. Another extraordinary move. So we've got extraordinary moves in wheat, in nickel.
Gas? Have you seen gas?
I've seen the
oil's
price
going
of,
crazy.
Have you seen the price of gas?
Yeah.
And this goes back to 1990. And so nickel's used for to produce stainless steel. It's like a key ingredient in batteries, in
EVs.
electric vehicles.
Yep.
And so this is a slight problem over and above the problems we've seen before. So I don't know if this is going to be the trade of a lifetime, whether you short nickel now, but that just looks totally out of place. But having gone through the last couple of years, a lot of things look a lot out of place. So I don't know where this one's going to go.
So trading's still suspended on the LME. So you can't even
do anything.
But tough to get yourself off Russian oil when nickel prices are going crazy, going to EV. The last one, just really quickly, Reserve Bank. So Phil Lowe came out and said, I quote, given the outlook, it is plausible that the cash rate will increase later this year. So it was only November last year that he said, definitely not before 2024. And this is central banks have been pushed into this corner, maybe
100%.
of their own doing.
What do you mean of their own doing?
Well, they come out and make these statements like, we're not raising rates. Like, I don't think you can ever say.
But they've always said data dependent. They've caveated it with data dependency.
Yeah.
But isn't this a prime example of data dependency? Like, who the hell knew that was going to be an invasion, which would then lead into sanctions that we've never seen in our lives, which then led on to record nickel prices, record wheat prices, and the volatility of everything.
Yeah, no, absolutely. So the other thing I noted is futures are pricing in 5 increases in the cash rate this year in Australia, which I was shocked by. That beginning in July is the expectation. So 1.28. 1.28% by the end of the year is what they're expecting.
Is this another supply shock issue?
In what way?
Because that's causing inflation.
Oh, the supply. Yeah.
Or is it wage inflation that's genuinely pushing up the prices of things? I'm not convinced
is
that's
wage
the case.
Inflation out of control? Because the last numbers the RBA put out said that it was less than 3%. 3% is what they're looking for.
I wouldn't say it's growing, which is what we've wanted for some sort of stability.
2.5%.
But I don't think it's out of control to the extent that you have to start raising interest rates.
I think it's supply. I
agree.
I think it's it's not income. It's goods and services, inflation,
I agree.
Supply. Yeah.
And
can they wait it out?
I
doubt it.
I don't think they can. I reckon they're in the shits.
You wouldn't want to get it wrong because far out it would be.
We're going to have self-induced. So you know what's going to happen? You're going to get
all over again.
You're going to have your 2024 recession call, right?
Maybe too early. Maybe I'm too late. Maybe it's next year. All right. We'll see.
All right, let's jump into tips and recommendations. Right. What do you got for us?
Okay, so I'm off the donuts. Not really. Still waiting for those tips, by the way.
Does anyone know anyone from Daniel's Donuts? Can someone reach out to us?
They need to fix that recipe. I'm happy to consult. Happy to help them out. Right?
Let's move on.
All right, so I listened to this podcast from the guy who wrote Downfall, which is the case against Boeing. Now, this is on Netflix. This is the...
Hold on, what was the title of the...
Downfall, the case against Boeing.
Have you watched it?
I have.
It's on my list.
Far out, man.
Is it good?
Really good. Really, really interesting in a really nerdy type of way.
How long is it?
Fascinating.
It's one doco.
An hour?
Yeah, okay.
I think.
Oh, you beat me to it.
Yeah. So for those who don't know, it was the 747 MAX. So it was really interesting. They went into why Boeing produced the 747 MAX. The whole background story, fascinating. Essentially, it was to compete with Airbus. And so they introduced this, I don't think I'm giving anything away here, but they introduced this new software called MCAS. And the whole idea was if the nose of the plane was starting to rise up, which can cause stalling, it would automatically tilt the nose back down. The problem is they never let any pilot know that they'd put this thing in. So
what do you mean?
Well, so Boeing, in order to release the planes quickly, they couldn't make any major changes. Otherwise, pilots had to go through a whole lot of training and they had to get it all approved from the FAA. So they decided to keep it all quiet and not tell anyone. And so the software is based on these little sensors on the outside of the nose of the plane, which can get damaged super easily, according to so many pilots. So,
because like wind and stuff.
Yeah, like a bird hitting it or just anything. So these things were faulty, and so the plane thought the nose was tipping up when it actually wasn't, and so it was constantly trying to push the nose down. And then even when they hit the override, something happened at the back end that just basically the speed was so quick that the flaps at the back tilted down, which just pushed the plane into a unavoidable nosedive. Really, really well put together. Absolutely recommend it to
put it together?
Anybody. No, so I was listening to the guy who I think he wrote a book on it, and he was saying that
no, it's not produced by Netflix.
no, that they just
Imagine documentaries.
funded it.
Yep. No, they
But
just
they're saying the creative life. They basically just said, "You do what you got to do. You produce this however you want to produce it. We'll show it." And they were like,
Wow.
"Wow, this is amazing."
Yeah,
like,
that's
Netflix
cool.
have just, they're just so free. And I've heard that a few times with documentaries and whatever else, that they're just happy to go with whatever. If you want it to be an hour, 50 minutes, 30 minutes, whatever, you just do what you think is right, and they'll screen it. So, Downfall, the case against Boeing.
100%
Absolutely amazing.
It's on my list.
So eye-opening. And but the other thing I'll point out before I flick over to you is they pointed out so many times that the last 10 years has been the safest period in aviation history. Notwithstanding what happened here, but planes have been exceptionally safe.
Whatever happened to the Malaysian Airlines? Did they ever find that plane?
No.
That's
Lost. Gone.
mind-boggling, isn't it?
It'll come back in 10 years. What was that show that you were watching where the plane disappeared for 10 years?
Oh, yeah.
Up in the air.
Yeah. I can't remember the name.
I don't know.
We
you can only hope,
we're
right?
still watching
That's
it.
pretty terrible. But yeah, so really fascinating. Some great stuff in there.
So I started watching Did you watch? So I've been watching Reinventing Anna.
No.
Have you seen it?
No.
Inventing Anna. I'm sorry, not reinventing. Inventing Anna.
That's the sequel.
Shh.
I haven't even heard of it.
This
So tell me about
this was on the recommendation of a client who said you got to be watching this. So it's about this young girl, a socialite who goes out and basically defrauds a number of wealthy people in New York, families, banks, hotels, etc. It's like
there's a recurring theme
it's like
here,
it's like the Tinder
Tinder
swindler.
swindler.
And I don't know if you watched Ozark, but
Man, I love that.
you know
show.
Ruth from
Yeah,
Ozark.
yeah,
So it's
yeah,
her.
yeah.
She plays.
Oh,
this
seriously?
chick.
Okay.
Man, she's good.
That's a brilliant show.
She's it's a very different character, but she plays her Anna. She plays Anna really, really well.
Yeah, right.
And so she goes and defrauds a whole bunch of people, and she gets convicted. Well, it's alleged she's in jail. She gets denied bail, and so she's in jail. So I watched episode number 1 last night. I've just started, and I was like, man, this is really not that exciting.
Oh,
but
no.
I think it's kind of just I'm praying that it's going to get better. Rotten Tomatoes, I just looked, have given it a 63%. I'm not listening to Rotten Tomatoes.
Okay.
IMDb have given it a 6.9. Google's given it an 83. Comparing that to the case against Boeing, Rotten Tomatoes at 90%. Google at 91. IMDb at 7.4.
Yeah.
What the hell's Metacritic? I've never seen Metacritic
No
before.
idea. 7.4.
7.4 IMDb.
That's
But anyway,
should be higher.
so she goes into jail, and this reporter hears the story, and she basically goes independent while she's working at this newspaper to try and uncover this story.
Okay.
And her superiors are not allowing her to run the story, so she's running it under the radar.
Right.
And so she goes to the jail and visits her, and the story's just unfolding.
Right.
So
How many episodes will you give it before you can it?
3.
Yeah. Right. Okay.
So the first one,
An hour? Are
They're an
they?
hour
Hours?
each.
Okay.
Yep.
3
But
hours. That's
it's
enough.
like 7 or 8 episodes.
Okay.
So we'll see.
Yeah. Right. Interesting. All right.
So don't
one.
dive into it yet. Maybe give me a
No.
couple more episodes, and I'll let you know if it's worth.
Still got to watch
watching
the
or not.
Tinder swindler. I keep thinking about
Oh,
it.
you haven't watched that yet?
Nah, man. I keep forgetting. Far out. It's got no time. Time's a valuable commodity.
Well, and the price of commodities are going up. On that note,
Yes.
let's. Has time gone up? Is there a time index? Time's the same.
I don't know, but
We've all got the same
I
amount
feel
of
like
time.
it's valuable. So it's going
Let's wrap up. Hit us up on email. Check out the YouTube channel. And I think we're getting close to like 100 subscribers on our YouTube channel.
nice. That's all right. First 100. Got to start somewhere.
so there you go.
Daniel's Donuts. Send me your recipe. No.
They're not going to
touch.
send you the recipe.
Get
Get in
with
touch.
me. No, they shouldn't. I'm not making them.
You're just eating them. See you next week.
Cheers, guys.